Everyone knows the story of the Oracle of Omaha, the folksy billionaire sipping a cherry Coke. But beneath the wisdom is a playbook, a set of cold, structural mechanisms for building a trillion-dollar empire. This is how one man became the market. It starts not with a stroke of genius, but with a corporate corpse. In 1965, Buffett buys Berkshire Hathaway, a dying textile mill. He doesn't want the looms, he wants the legal shell, a vehicle to deploy capital without triggering taxes. A worthless company becomes the foundation. Mechanism 1. The float. In 1967, he buys an insurance company. You pay your premium today, they pay a claim years from now. That gap is the float, free money to invest. It grew from $39 million in 1970 to over $170 billion today. Most investors have to pay banks for leverage. Buffett's leverage pays him. Mechanism 2. Moats. He buys businesses with impenetrable advantages. Coca-Cola, a brand so powerful it sells sugar water at a massive premium. Burlington Northern, one of only 7 major railroads in America, a literal monopoly on tracks. This isn't value investing. This is monopoly collecting. Mechanism 3. Never sell. The IRS takes over 20% when you sell a stock. Buffett's solution is simple. He doesn't. His famous line, "Our favorite holding period is forever," isn't just investment wisdom. It's tax arbitrage. He publicly calls for higher taxes on the rich, while his own structure defers billions indefinitely. A ProPublica report calculated his true tax rate at just 0.1%. Mechanism 4. Crisis capital. September 2008. The financial system is imploding. Goldman Sachs is bleeding out. Their CEO makes a desperate call to Omaha. The terms are brutal. $5 billion for preferred shares paying a guaranteed 10% dividend forever, plus warrants at a steep discount. They called it stabilizing the system. It looked a lot like predatory lending with a press release. Then there are the contradictions. In 2002, he calls derivatives weapons of mass destruction, while Berkshire holds billions in exposure to them. At the Salomon Brothers scandal, he told Congress, "Lose a shred of reputation and I will be ruthless." He threw traders to the regulators and walked away a hero. The pattern is clear: a public image of a patient steward, an operating reality of ruthless value extraction. And now the Oracle has stepped aside. Greg Abel inherits the portfolio, but he doesn't inherit 60 years of untaxed compounding. He doesn't inherit the reputation that brings desperate CEOs to his door, begging for terms. The playbook, however, survives. It's been copied, not the stock picks, the structure. Private equity, sovereign wealth funds, tech giants, they're all using it. They learned that Buffett didn't just beat the market, he became the market. He proved the game is rigged toward permanence, and the longer your time horizon, the more the rules bend your way. The only question left is whether you're playing his game, or if you're just the liquidity he's playing against.
So are you playing his game, or are you just liquidity he's playing against? Every market needs two sides, buyers and sellers, patient capital and panic sellers. Warren Buffett built his fortune because someone always had to be on the other side of his trades. When Berkshire waits on cash for years, someone has to be the crisis. The question isn't whether the Buffett playbook works. The question is, which side of the trade are you on? Let's run the test. Sign 1. You sell during panics. March 2020, the market crashes. Retail investors sold at the bottom. Berkshire was buying. If you sell because you're scared, you're the liquidity. Sign 2. You chase returns after they happened. Bitcoin at 60,000, Nvidia after it quintupled. If you're buying because something already went up, you're the exit. Sign 3. You pay fees to middlemen who don't beat the index. The average fund underperforms but still collects their fee. You're paying for the privilege of losing. Sign 4. You check your portfolio daily. Warren Buffett reads annual reports. If you're reacting to price swings, you're playing a game designed to make you trade, and high-frequency funds spend billions to be on the other side of that trade. Sign 5. Your time horizon is shorter than you think. You say long-term, but when the market drops 20%, do you hold? Most people's long-term is 18 months. Buffett's is 60 years. If 3 or more of these sound familiar, you're not playing the game. You are the game. Now, let's be honest about what's off the table. You can't replicate the float. You don't own an insurance company with billions in premiums to invest tax-free. You can't replicate the crisis access. When Goldman Sachs is dying, they don't call you. You're not on the list. You can't replicate the tax structure. Berkshire is a corporation that never pays dividends. Your brokerage account gets taxed. And you can't replicate the time. Buffett started at 25. He has 69 years of compounding. If you're 40, you don't have 60 years. The Buffett playbook isn't a strategy you can copy. It's a structure that requires resources most of us will never have. But that doesn't mean you walk away with nothing. Here's what you can steal. First, stop being liquidity. This costs nothing. Don't sell in a panic. Don't chase a rocket ship. Don't trade because you're bored. Every time you resist, you're refusing to be someone else's exit. Second, extend your horizon. The most powerful decision isn't picking the right stock. It's structuring your life so you don't need to sell for 20 years. Emergency fund, low fixed costs. The less you need from your portfolio, the longer it compounds. Third, buy the toll roads, not the travelers. Buffett buys the infrastructure everyone has to use: railroads, credit card networks. Own assets that collect rent from activity, not assets that depend on being right about the future. Fourth, apply the moat concept to yourself. Your career is a business. What's your competitive advantage? Build a career moat with rare skills and irreplaceable relationships. Compound your income the same way Buffett compounds capital. And fifth, understand the game before you play. Know who's on the other side of your trade. The first edge is knowing the game is rigged towards permanence. Because Warren Buffett didn't discover a secret, he discovered a structure: free leverage, monopoly economics, tax deferral, and above all, time. 60 years of compounding, while everyone else was trading and panicking. The giants copying him, they aren't smarter. They just have longer time horizons and structures that don't force them to sell. You can't build Berkshire Hathaway, but you can stop being the liquidity that Berkshire feeds on. You can extend your horizon. You can build a moat around your own earning power. The game is rigged towards permanence. That's the pattern. The longer you can stay in the game without being forced out, the more the rules bend in your favor. Buffett proved it for 60 years. The only question left is whether you'll spend the next 20 building your own structure or providing liquidity to someone who already has. If you want to understand how the ultra-wealthy actually operate, not the myths, the mechanisms, subscribe. We investigate the hidden rules every week.